Warren Buffett, born on August 30, 1930, is an American business magnate, investor, and philanthropist. He is widely regarded as one of the most successful investors in the world. Buffett is the chairman and CEO of Berkshire Hathaway, a multinational conglomerate holding company based in Omaha, Nebraska. Buffett began his investing career at a young age and developed a value investing approach, focusing on long-term investments in companies that he believes are undervalued. He is known for his patient and disciplined approach to investing, often holding stocks for many years. Buffett has achieved remarkable success through his investment strategies and has become one of the wealthiest individuals globally. Buffett is also a renowned philanthropist and has pledged to give away the majority of his fortune to charitable causes. He and his late wife, Susan Thompson Buffett, established the Susan Thompson Buffett Foundation, which supports various causes such as education, healthcare, and family planning. Buffett is often referred to as the Oracle of Omaha due to his exceptional investing acumen and his annual shareholder letters, where he shares his insights and wisdom on investing and business. He is widely respected for his integrity, simplicity, and long-term perspective in the world of finance. Warren Buffett's current net worth is $106 billion. Warren Buffett evaluates a company based on several factors, including business model and competitive advantage. Buffett looks for companies with a strong business model and a competitive advantage that will allow them to maintain their position in the market over the long term. Management quality. Buffett considers the quality of a company's management team to be crucial to its success. He looks for companies with honest, competent, and shareholder-friendly management. Financial performance. Buffett analyzes a company's financial performance, including its earnings, cash flow, and return on equity, to determine its profitability and potential for growth. Valuation. Buffett looks for companies that are undervalued by the market, meaning that their stock price is lower than their intrinsic value. Brand value. Buffett also considers the strength of a company's brand and reputation, as this can be a significant factor in its long-term success. Long-term outlook. Buffett looks for companies that have a long-term outlook and are focused on building sustainable competitive advantages. He prefers companies that have a history of steady growth and earnings, and that are likely to continue to perform well in the future. Moats. Buffett often talks about a company's economic moat, which refers to its ability to maintain its competitive advantage and fend off competitors. He looks for companies with strong moats, such as brands, patents, and other barriers to entry. Debt levels. Buffett is generally wary of companies with high levels of debt, as this can make them vulnerable to financial distress. During economic downturns, he prefers companies with low debt levels and strong cash flows. Market share. Buffett often looks for companies with a dominant market share in their industry, as this can provide a strong foundation for future growth. Industry trends. Buffett also considers broader industry trends and how they may affect a company's long-term prospects. He looks for industries that are likely to grow and prosper over the long term and avoids industries that are in decline. By considering these factors, Buffett aims to identify companies that are likely to provide strong returns over the long term. He famously advises investors to be fearful when others are greedy and greedy when others are fearful, meaning that he looks for opportunities to buy stocks at a discount when the market is pessimistic. Overall, Warren Buffett's approach to evaluating companies is focused on identifying high-quality businesses that are likely to perform well over the long term. By considering a range of factors, including competitive advantages, financial performance, and long-term outlook, he aims to identify companies that are undervalued by the market and likely to provide strong returns for investors. Here are some additional factors that other investors may generally consider when evaluating a company. Industry analysis. Investors should consider the industry in which a company operates, including its growth potential, competitive landscape, and regulatory environment. By understanding the broader industry trends, investors can gain insights into a company's future prospects. Financial ratios. Investors can use financial ratios to analyze a company's financial health and performance. Ratios such as the price-to-earnings ratio P/E ratio, return on equity ROE, and debt-to-equity ratio can provide insights into a company's profitability, efficiency, and leverage. Management quality. The quality of a company's management team can have a significant impact on its success. Investors should look for companies with experience and competent management teams that are focused on creating value for shareholders. Competitive advantage. Investors should consider a company's competitive advantage or its ability to maintain its position in the market and fend off competitors. Valuation. Investors should consider a company's valuation, or the price at which its shares are trading relative to its earnings or other financial metrics. By analyzing a company's valuation, investors can determine whether its shares are overvalued or undervalued. Growth potential. Investors should consider a company's potential for growth, both in terms of revenue and earnings. This can include factors such as market size, product pipeline, and geographic expansion plans. Corporate governance. Investors should consider a company's corporate governance practices, such as board independence, executive compensation, and shareholder rights. Companies with strong governance practices are generally more transparent and accountable to shareholders. Dividend yield. Investors who are seeking income may be interested in a company's dividend yield, which measures the amount of dividends paid out as a percentage of the stock price. Companies with a high dividend yield may be attractive to income-seeking investors. Environmental, social, and governance ESG factors. Investors are increasingly considering ESG factors when evaluating companies. This can include factors such as a company's environmental impact, labor practices, and ethical standards. Technical analysis. Some investors use technical analysis to evaluate a company's stock price trends and trading patterns. technical analysis, can provide insights into a company's short-term performance and help identify potential buying or selling opportunities. Competitive landscape. Investors should consider a company's competitive landscape, including the strength of its competitors and the barriers to entry in the industry. Operating in industries with high barriers to entry and limited competition are generally more attractive to investors. Management incentives. Investors should consider the incentives of a company's management team. Companies with management teams that are aligned with shareholder interests are generally more likely to make decisions that create value for shareholders. Customer satisfaction. Companies with high levels of customer satisfaction are often more successful. Over the long term, investors should consider a company's reputation among customers and its ability to maintain strong customer relationships. Innovation and research and development (R&D). Companies that invest heavily in innovation and R&D are often better positioned to develop new products and services that can drive growth and create value for shareholders. Economic and geopolitical risks. Investors should consider the potential impact of economic and geopolitical risks on a company's business. These risks can include factors such as inflation, interest rates, currency fluctuations, and political instability. By considering these factors and conducting thorough research, investors can make informed decisions about which companies to invest in. It is important to remember that investing involves risks and that no investment strategy can guarantee success.